Welcome to DHJJ's webinar on tax reform, what you need to know before 2017 ends. For today's webinar, you will be muted, but if you have a question, please utilize the chat function. If you have questions after the presentation, please email the presenters. We will also send the slides in a follow-up email, so if there is anything you missed or we can't go in depth on during the presentation, you will have a copy of this presentation. Today, your presenters are Terry Cicero and Scott Singer. Terry and Scott, I'll let you take over.
Great, thanks, Stephanie. Thanks everybody for joining on the webinar today. We're excited that you joined in. There are some moves that everyone should consider and look at before year end, and we really want to get this out to everybody so that everybody knew that there are some opportunities on the board. While the pending reform is not final by any means, there are some things that we need to look at before year end, and we want to make sure everyone's aware of those. At DHJJ, we're working hard to look at everybody before the end of the year, and we want you to know that we're looking at it for our clients, but at the same time, we want you to know what's going on so that you are aware. So if we are reaching out to you to talk to you, you already have some background about what we're looking at here. So the focus on today is really what possibly you can do before year end. And we're not going to focus too much on all the potential changes. It's really how these changes affect year end and what you can do before year end in anticipation of what may change next year. So in light of that, we're not going to go into all the details. Look for a further webinar or seminar in January on that topic or in the coming year about going forward. So today we're going to focus more on what we can do before year end. So with that in mind, the House and Senate passed separate tax bills. So clearly that couldn't go to the president, had to go back, and they needed to work out some disagreements there. But let's focus on the agreement and what they both agreed on. They want to limit property tax deduction to $10,000 and eliminate state income tax deduction. And my asterisk at the bottom there is just because it's agreed on doesn't mean it will be in the final tax bill. And then the final tax bill would still need to pass both House and Senate. And a perfect example of that is already yesterday, word of a potential final agreement came out where the $10,000 would now be a limit combined between state income tax and property tax. So it shows you how flowing this is and how fast things can change. So again, this is just based on the House and Senate bills that were passed, and already yesterday there was some potential final agreement. It's not official yet, but agreement that it would be $10,000 combined. The other important thing is they both agree to nearly double the standard deduction to $24,000 for married filing joint or $12,000 for single status. Those are the main parts of, I'm going to focus more on the individual year-end planning. I'll turn it over to Scott in a bit more about some of the flow through and business side of things. But for the next few minutes, I'm going to focus on really these deductions and what you should consider before year end in light of these potential changes. So on the next slide, you'll see what the brackets potentially could look like. This at a high level won't affect your planning before the end of the year too much. We don't have the final brackets yet. You could see what the House has proposed versus what the Senate has proposed versus above in green what it is today if there were no change. So you can see already potentially the top rate of the 39.6 versus the Senate wants to have it at 38.5. So that's a small difference. But in yesterday's preliminary agreement that came out, it's going to drop to 37%. So that would mean if you're in the top bracket, essentially, that would lower to 37%. And then there's some compressed brackets on the House side that needs to be shaked out between the House and Senate. So we'll keep that in mind, but that's not the what we're going to emphasize and look at today. It's going to be more on the deductions. So on the next slide, we're going to look at, so what to consider before year end. Should you consider prepaying your property taxes? And the reason for that, remember, is that if they want to limit it to 10, then your property tax bill is your property tax bill is more than $10,000, you know, you should consider that. But even if you're less than $10,000, we also want to look at whether that makes sense. But there's a case coming up in a couple of slides where it really explains this. So these are, I'm going to go through the potential considerations, and then when we go through the case study, we'll go through and look at these different things. So based on yesterday, that $10,000 will be a combined $10,000 of your property tax and state income tax. So if you're going to be more than that, you're going to be limited to $10,000. That includes your first property, second property, and your non-rental investment property. So your rental properties are still okay. You don't need to factor that into the equation. We're talking about Schedule A itemized deductions, if you're familiar with the Schedule A on your 1040. That's what is being focused on here. The charity, you might want to consider accelerating charity. And we'll go over this case study, which really shows you the benefit of accelerating charity and possibly considering a donor advised fund. And we'll look at that. Then you might want to accelerate other deductions also. And medical is an example if you're over 10%, but just yesterday it looked like they might keep the medical included too. So again, this is ever changing, and you really need to work with your advisor on these different things.
They did keep the medical.
Yeah, so they did keep medical in the agreement.
In the law,
yeah.
As it is right now.
Yeah, so right now it's law. And the plan would be, the House didn't want to keep it, the Senate did, so it looks like the Senate's going to win there. So one other potential thing is bringing income to utilize deduction. So if you have so many deductions this year that you're offsetting a lower rate of income, you might want to bring in some income. So that's another consideration. So really work with your advisor on that. You just don't want to do this blindly because you don't know the benefit of doing that. One example that we'll talk about in just a second here is the alternative minimum tax, or the AMT that you could pay. Well, you really want to know the benefit of that next dollar deduction. Are you saving 40%? Are you saving 25? Are you saving 0? That's what you really want to know. On the next slide, with the AMT and the alternative minimum tax, the House proposes to eliminate and the Senate proposes to increase. And it looks like the Senate may win there, right, Scott?
Right.
With the AMT staying in place there. So the AMT looks to be still in place.
For individuals.
Yes, for individuals. So the AMT in essence is going to just limit certain deductions such as property taxes and state taxes. So that's important. So why is that important? For year-end planning, for example, you may not want to prepay those items. So let's go to the next slide, because this really sort of captures what we want to do before year-end. So Bill and Jill here, they have, under the No Planning 2017, they have state tax paid of $8,000, property taxes of $11,000, mortgage interest of $9,000, and charity of $3,500. So they're going to itemize with their $31,500. Now, for 2018, assume they have the same deductions. Again, this is under the House and Senate plans. They would be limited to $10,000. They would get no state tax paid. Under the plan yesterday, they can choose what they want to take. They can take up to $10,000 combined between the two. So it really doesn't change this example. The mortgage interest, $9,000 would stay the same, and charity is the same. So the total itemized in that case is $22,500. So compare that to the standard deduction, which is $24,000 proposed, and then they would take the standard deduction next year. So in that case, is there some planning that we can do for the fact that they wouldn't get benefit of their taxes and charity in 2018? Because if you take out taxes and charity, you would still take the standard deduction. So even with those in there or without, you're going to take the higher standard. So let's look at planning. And with planning, you're going to prepay taxes of $11,000 before the end of the year. So you go, if you're in DuPage, you can send a check to DuPage by the end of the year. You can, DHJJ.com, if you go there, we have instructions on the DuPage and surrounding counties on how to prepay taxes. Cook, you could prepay half. Cook's been so busy that you're able to do it online this year and pay half. So you can also pay your 2018 January mortgage payment. It's not huge, but every bit helps if you're not going to itemize. In this case, they get about $700 more of deduction. And you can accelerate charity that you would have given in 18 into 17. So with those items, with the planning under 2018, you're going to get more deductions in 17. Your property taxes are going to double to 22. Your mortgage interest goes up a little bit, and your charity's at 7. So your total itemized at 46,700. You're going to get a lot more itemized deductions, and you're still going to take the standard deduction next year. So just by accelerating those 3 items and accelerating a little charity that you would have given next year, you have additional deductions of $15,200 this year, and you still have $24,000 next year. So if you're at the 25% rate, that's an extra $3,800 in your pocket. If you're at 39.6, that's an extra $6,000 in your pocket. This is not just a timing difference. This is a permanent difference under the proposed law. Just by accelerating these things, you get that money in your pocket by accelerating. One further is to consider a DAF, the donor advised fund in the shaded yellow column. A donor advised fund, essentially, you can front load future years of charity, get that into your donor advised fund. You can set it up with, say, a Schwab or a Fidelity, and we'll have more. If you want more info on the donor advised fund, just based on time today, you can email me, and I can send you something more about the donor advised fund. My email is at the end. But essentially, you put the money in today, deduct it all today, and then give it to charity from the fund in future years at a high level. And it's important to note the Hills are not subject to AMT here. So with the donor advised fund example, you can see the savings increase even more because they're going to get itemized of $57,000 and save up to $10,000 under 39.6%. And sorry, real quick at the beginning, I'm Terry, so at the end, if you're looking for the email, you can email either of us and we'll get you the info you need. But definitely email me, Terry Cicero, tcicero@dhjj.com. It's toward the end for more info on the DAP too. So that's case one. You can see clearly the benefits of accelerating deductions here. Again, it's important to note, nobody's asking you to increase what you're doing. It's just changing the timing of what you already plan to do. A second case here that we wanted to show you was Gene and Jean Miller, who have state tax paid of $9,000, property tax paid of $14,000, mortgage interest of $15,000, and charity of $5,000. So they itemized, they're at $43,000. And what's different here is their itemized in 2018 will be $30,000. So they're still above that $24,000 that's proposed. And you may stop there and say, I'm going to itemize, so I really don't need to do anything before year end. But you can see here that if we prepay property taxes, pay the January mortgage payment, and do an additional year of charity and accelerate that, we're going to increase our itemized deductions to $63,200 this year, and we'll still take the standard next year of $24,000. But look at the combined deductions. We're going to take $73,000 combined with no planning, and with a little bit of planning, you're going to get $87,200. So just by these small things to do, you're going to get additional tax savings at 25% of about $3,500 and at 40% about $5,600. And again, the Millers are not subject to AMT. So you do need to watch the AMT because of the taxes. So you do need to watch that. So with that, I need to turn it over to Scott for the business side. And it's just important on the individual side. We wanted to get this in front of you so that you know what we're looking at and what you should also consider before the end of the year. Again, this could change in the next coming days, but based on this and what's agreed between the House and the Senate, this looks like things that people should be doing. It's just before you pull the trigger, making sure that you do get the benefit of those deductions. So with that, here's Scott.
Well, hello, everybody. Thanks for joining us. I'm going to talk a little bit about what's going to happen to business owners and things that we can do with what's left in the year 2017 and sort of what you can expect to see happen in 2018. As Terry has alluded to, this is very fluid. Conference committee just met yesterday. They're meeting again today. Last night I was actually watching the proceedings, and you can actually see all the people speaking and all the questions and answers that are being disseminated throughout the committee. Four things we want to talk about today. One is what's going to happen to the pass-through owner. What can they expect in terms of taxation? The second is the Section 179. Should we go out and purchase fixed assets? What to do? Why to do it? Ditto as far as bonus depreciation and why that's important. And then we're going to talk about some tax planning ideas. On this slide right here, I'm just simply restating what the current day rule of law is. You know, if you have a pass-through entity, obviously the income, gain, loss, deduction, credit, all that flows through to the individual owner, and then is taxed on the individual owner's rate of 39.6%. The House and the Senate both recognize that some form of corporate tax reduction needed to take place all across the country just to keep us competitive with what's happening in the rest of the world. So the House and the Senate bills kind of crafted different approaches. The Senate bill is actually the one that was approved yesterday in conference. I'm just going to mention about the House bill just so that you can get a sense for kind of the approach that was going to be taken. And as we said, it's very fluid because yesterday, before the announcement, the new corporate tax rate was going to be 20% starting in 19, and now it's 21% starting in 2018 for C corporations. And obviously this begs the question, if I'm a pass-through entity owner, a partnership, or an S corporation, or even if I'm a sole proprietor, should I now be a C corporation? Is there a good reason for doing this? And in some cases, yes. In other cases, no. So we have to take a look at that for you. The centerpiece to all this is what is referred to as qualified business income. Qualified business income effectively is just all income from the business. Under the House bill, they would have actually taken your qualified business income and they would have actually bifurcated it into two components. One would have been a wage component, the other component would have been an investment component, would have been a 30-70 split. 30% of your income would have been taxed at a maximum rate of 25% or less, depending on whether your tax rates were below. The other 70% would have been subjected to tax at ordinary income rates. And there was a provision in there allowing capital-intensive businesses to, like a manufacturer, to get an increased amount subject to 25%. The one thing that both the House and the Senate bill have provided is that any free benefits that they're giving here are not going to be applicable to service-based enterprises such as companies involved in fields of health, law, engineering, financial services, athletics, performing arts, accounting, what you know as personal service corporations. The Senate bill, as I said yesterday, was actually the one that was approved in conference, so this is what we expect to see. What's going to happen is that we're going to tabulate what your net income is, and then we're going to subtract 20% of your net income. There's going to be a limit, which is going to be 50% of the W-2 wages allocated to the pass-through entity owner. And I actually have an example of how we think this is going to work. Like the House bill, service businesses are not going to be eligible for this 20% deduction. But for those other entities that are, you're going to end up with a top marginal rate of about 29.6%. And I'll show you how that comes up. So like I said, this was adopted by the pass-through, by the conference committee just yesterday. So here's an example. We came up with our own example. Since Congress doesn't bother to give examples, we decided to come up with our own. So here's an S corporation that has $1.5 million of bottom line net income. You know, we start off with $2 million in sales, we pay compensation and or other expenses. The company net income is now $1.5 million. Under the Senate bill, you're going to take this $1.5 million, you're going to take a 20% deduction for it, which is going to be $300,000. There's going to be a limit that's equal to 50% of your qualified wages, and that's the lesser amount. So actually the deduction is going to be $250,000. And if you follow along down in the column, I give you what the actual tax on $1.5 million would have been under current day law, which would have been $668,250. But if you take the 20% deduction coupled with the lower tax rates that are going to apply, the actual tax on the same business income is going to be $524,000, or a savings of $144,000. The effective tax rate there is going to be just a shade under 35%. If you look at the House bill would have split your income into a 30-70 split. You would have worked through the same calculation, and you would have paid considerably more tax. under the House bill. So fortunately, the Senate bill is what is going to pass here. Next slide, please. Normal questions that we get at this time of the year: should I go out and purchase fixed assets? I was planning on purchasing fixed assets. Can I write off my fixed asset purchases right away? The answer is yes, you can. We have 2 ways to get it done, depending on whether you're profitable or if you're not quite profitable. We have the Section 179 limits, which I've presented here, and then I have the bonus depreciation limits, which was on the next slide. The bonus depreciation is really useful because if companies are not profitable or operating in a tough environment, we still have a ready way to get your fixed assets expensed in the current year. Under the Senate bill, which is what we're expecting to see pass, you'll get 100% of the deduction. The problem with bonus depreciation is the Illinois tax add back. So we have to work with you to make sure that you understand what's going to happen for federal and Illinois tax purposes. I came up with some tax planning ideas. Some of this may or may not work for your business enterprises. If you're using the cash basis method of accounting, something you may want to consider doing is actually delaying your billings if you possibly can, so that customer payment actually is received in 2018, not in 2017. A, you're going to get a deduction that you're not going to get in 2017, and B, you're going to get a lower tax rate in 2018, also that you're not going to get in 2017. So why not shove the income into 2018 where you're going to pay overall less tax on it? All things being considered equal, you're going to get the income. Why not just pay less tax on it? Alternatively, if you're on the accrual basis, you just can't delay billings because there's a rule that says that it's when you have the right to receive the income that what counts. But under certain circumstances where you're delivering product, it may be possible to postpone the sale or defer deliveries of merchandise into 2018 for the same reason. Take advantage of the lower tax rates. For business entities of all sizes, consider prepaying some of your business expenses or your supplies. Consider doing that right now. Why not accelerate the deduction into a tax year where you have the higher rates applicable here, and that way you can actually save tax. You don't want to go hog wild on this, but under certain circumstances, we can actually prepay 1 year's worth of expenses in advance and not run afoul of any kind of significant problems with the IRS. So something to take advantage of and look at. I alluded to this already. The fixed asset acquisitions. If you're fixing to make fixed asset acquisitions, consider accelerating it into 2017. The biggest issue we run into is it got to be placed in service before the end of the year. You just can't buy it. You actually got to put it in service. Starting in 2018, we're going to be talking with a lot of businesses about converting to the cash basis method of accounting. I put down what the limits are, but right now Congress has seen fit to greatly expand the number of companies that can use the cash basis method of accounting. We certainly want to take advantage of that because it actually gives you flexibility in structuring your affairs. And some of you will be able to do this notwithstanding the fact that you actually have inventory. So that's a good thing. Finally, there is an onerous provision in there about the interest only being deductible to the extent of 30% of modified income. For companies that are highly leveraged, you may want to consider channeling some of your excess cash flow to pay down your business debt so that you don't run afoul of the interest cap limit here. As I put here at the bottom of the page, anything you decide to do here or that you're thinking about, make sure you consult with us. We want to make sure A, it's going to work, B, that you're going to get a benefit for it, okay? And then just continue to follow along with us as we see what happens here with the rest of the bill. They're anticipating voting on this, I believe, December 18th, next week, okay? And that's my presentation for today. Obviously, any questions, you can contact either myself or Terry, okay? Thank you.
Great. If anyone has any questions, you can input them into the chat window right now. We have a few minutes that we could take questions.
And one of the questions that came up was regarding property taxes, and I briefly alluded to about which ones you can deduct. So that again, to reiterate, is the 10,000 combined now on your state and property. But again, you don't need to worry about that rental. So that rental is still a separate property where that doesn't work into the mix. But your second home, your vacation home, that's all part of the 10,000 combined that you need to deal with there. So that one would be an issue. Well, if anybody.
So you have a question right here.
So we have a question about prepaying state income tax. So essentially, if you prepay, so when you prepay the state income tax, essentially what we're doing here is the prepayment that we're talking about is what you would owe. We're not saying to overpay your state tax. Typically, you would owe your fourth quarter state tax in January, and you owe your balance due in April. So if you foresee owing Illinois, if you're in Illinois, tax for fourth quarter due January 15th, or you're going to owe a balance due with your tax return, you may want to pay that tax before the end of the year. So say you're going to owe $5,000 for fourth quarter and $10,000 with the tax return. You may want to pay $15,000 to Illinois before the end of the year to get that deduction into 2017. Again, you need to watch for AMT, but again, if they're at that $10,000 limit next year, that may not even matter. And depending on your income, you may be subject to what's called the net investment income tax on your investment income, and then you can offset some of that. So that's why it's really important before you do these things to check the effect with the advisor, but most likely you would want to prepay that state income tax.
And we have another question here. Cars, do they qualify for Section 179? The answer is yes, they do. It actually depends on the weight of the vehicle and the type of the vehicle involved. If it's an SUV, we actually can take up to $25,000. If it's not an SUV, I think that the rate is now $8,000 that I can just that I can take as a deduction right off the top. So obviously there's a question about that. Let me know. And incidentally, the rates are now indexed so that the depreciation we can take on vehicles is actually going to increase with inflation over time. Another question, will the 2.9% investment tax go away next year? The answer is no, it will not. One of the provisions in the conference committee that just passed was the Affordable Care Act. There's no penalty for failure to comply with the individual mandate, but the net investment income tax, the 0.9% additional Medicare tax, those provisions are still in law and they're still on the books.
All right, well, that brings us to 1 o'clock. So thank you everyone for joining DHJJ today. If you have any other questions, please contact Terry or Scott or your DHJJ CPA. We will send you today's slides in a follow-up email. Thanks again and have a great day.
Excellent. Are we on?